Jenny Brown. Welcome to this week's MFB News, reporting to you live here from Sevenoak, where we have a hurricane going on outside. What is going on with the weather? At the weekend, the weather was so bad, we nearly put the Christmas decorations up. Then I remembered that it's November and didn't, but it was that bad. So first of all, I hope you fared the storms okay. I know that the weather's been fairly mixed across the country. I know there's been a lot of snow in some areas, so I hope that you guys are getting out and making snowmen and doing all the fun stuff. And I also wonder how many of you have actually got your Christmas trees up. We're walking around our local neighbourhood and I was amazed at how many people have got in early this year. Must say something about the state of where everyone's heads are in terms of kind of feeling good and stuff about the future. Anyway, in terms of what we're going to cover off for you today, we're going to do our usual look at what's been going on with lender pricing. It's a bit like the kind of up and down version of the hokey cokey, if I'm brutally honest. And then what we're going to do is this week we're going to keep it very, very mortgage focused. There's been a couple of pieces of lending criteria changes that have actually kind of raised some really interesting points that I want to kind of dig into with you. And then we're going to also just chat a bit about leasehold properties and ground rents and service charges and how they can impact mortgage underwriting as well. So lots of good stuff for you this week. Okay, now slightly better news in terms of swap rates. They have come down a little bit from last week, thank goodness. So as of 11:45 last night, 2-year swaps were at 4.13. 1 month ago, they were at just under 4%, and 1 year ago, they were at 4.8%. So we have definitely come in the right direction year on year. And actually, in terms of the ground that we lost in terms of rates going up most recently, the latest round of rate increases, actually we're starting to see things settle back down a bit there, and actually we're sort of like 0.175 above where we were 1 month ago. Very similar news for 5-year swaps. They're back down under 4%. Psychologically for me, that is an important thing. I can't really explain to you why, it just is. So as of last night, so 5-year swaps were at 3.88%. 1 month ago, they were at 3.79, and 1 year ago, 4.27. So again, as we can see, things have kind of eased back down. So what has this done for the mortgage market? How does this feed into you guys in terms of the rates that you're paying? So a softening of swap rates means a reduction of cost of funds for lenders, which means this paves the way for them to be able to potentially reduce their pricing, particularly if they are taking their funds, raising their funds to lend back out to you from the capital markets and thus paying swap rates. Different funding model for those lenders who are using retail deposits to save us money, essentially, because obviously their cost of funds is modelled in a sort of different way. So what have we seen? So we've seen actually a little run on rate reductions, thank goodness. We've seen Land Bay make reductions of 0.15%. We've seen Fleet Mortgages drop their rates down by 0.1. We've seen Lendco bring rates down by 0.3%. TML have released some limited edition rates. They haven't actually dropped the rates of their standard product range, but they brought out some new, slightly more attractive rates. So 2-year fixed rates are from 4.94, 5 years from 3.94. TML specialist lender, as are Lendco, Fleet and Land Bay. So the first thing to note here is these guys are very much looking at the capital markets for their funding. So their cost of funds has come down week on week, which, like I say, leaves the door open for them to make reductions. But the second thing is the specialist lenders. You won't be surprised to hear that if there's a 5-year fixed rate from 3.94, their cost of funds is currently sitting at around 3.9%. The reality is there's going to have to be some pretty hefty arrangement fees to be able to price that level. So when we're saying rates from, that is the base headline interest rate, but just keep in mind there could be some chunky fees attached to these. Foundation home loans have also released some limited edition rates, and also capital home loans as well. So capital home loans, 2-year fixed rates on their limited edition set from 4.04 and 5 years from 4.74%. So lenders are trying to react positively to the news where they possibly can. Now, conversely, we have seen some lenders price upwards, and this is where I'm talking about different pricing models. So depending on how they raise their funds, and you're going to notice a different type of lender here. So the lenders that we were previously talking about who have drop rates are all specialist lenders. They're not lenders who have savers money coming in that they're paying interest on. These guys are all going to the capital markets for their funds. So rate increases, we've seen the Mortgage Works, part of the Nationwide Group, very much a retail deposit taking institution. Their rates have increased by 0.3% on some of their products. However, they have decreased some of their HMO rates by 0.2%. We've seen the Clydesdale, part of the Yorkshire Building Society, I want to say, don't correct me on that, 0.3% increases on their product range. We've seen Boom Solutions, part of the Lloyds Banking Group, rates up by up to 0.23%, and the Yorkshire Building Society, our friends there, who are a fantastic lender, more sort of commercial leaning, rates up by 0.1%. So as you can see, a really mixed bag. And like I say, there's kind of two reasons why we're seeing some lenders go up and some lenders come down. The reasons the first reason, would be different funding models. The second reason could be purely timing. So it could be that some lenders simply hadn't put their rates up previously. Obviously their cost of funds has increased, and now they're sort of scratching their heads and thinking, oh God, we need to actually still make some money here as a mortgage lender. We're not a charity, we do need to make money. So we need to bring our rates up. So I suspect for those guys who are going up rather than down, it's a combination of didn't put their rates up previously, and also their funding models have changed. But I think in the round, a much more positive week that we've had, particularly since the, I want to say the autumn statement, but actually the run up to the autumn statement as well. Next week, we'll do a slightly deeper dig into kind of thoughts on interest rates going forwards and all that kind of stuff. But I think let's just quit while we're ahead on this one and say that actually it does certainly feel like things are starting to improve. Okay, now as I said earlier on, there's been quite a few pieces of lender criteria changes, which have actually sparked the kind of thought in my mind of actually these are all really interesting things just to dig into a little bit. So the first thing we've seen, which is quite a biggie actually, is BM Solutions have increased their maximum loan to value to 80%. Now I was trying to think back, and I don't think BM Solutions have lent to 80% loan to value since the credit crisis that I can recall anyways. This is quite a big step up. They certainly haven't lent to 80% in more recent years. So this is a really big bit of news. So now there are some terms and conditions that sit around the 80% lending. So first of all, the EPC rating can be no more than an A to C. And secondly, the maximum loan amount is £350,000. This certainly isn't going to work for everyone. But I think more positively, what does this tell us? So first of all, BM Solutions are by no means the only lender lending at 80% loan to value in the market. And what you find is there is quite a big step up in terms of pricing between 75 and 80% loan to value, because you are getting into the kind of top echelons, as it were, of loan to value lending. So that's across the market. That's not just the BM Solutions thing. The reason this is particularly interesting is what this really does is tell us where we think BM Solutions, we're owned by the Lloyds banking groups. This is a really big institution's kind of view on the market about where house prices are heading. Lenders tend to reduce their exposure, their loan to value limits, in a period of time where there is uncertainty around house prices. Lenders tend to come into high loan to value lending when there's confidence that the housing market is on an upward trajectory, and therefore if they're lending 80% loan to value, there is very, very little chance that actually they're going to end up in a negative equity situation, i.e. house prices will have fallen and our borrower is going to be left fairly exposed. So I think really for me here, the kind of overarching message is that actually in terms of what the really big players, the big lenders are thinking at the moment, is actually house prices are going to grow sufficiently over the next 2, 3, 5 years that actually would warrant them pushing themselves into lending at a loan to value they traditionally just simply wouldn't have gone into. Okay, another thing we've seen in the last week is Remortgages announced they're now going to do remortgages where you've owned the property for less than 6 months. They never used to do this. So this is an interesting one. So first of all, are Aldermore the only lender that now offer remortgaging inside of 6 months ownership? No. But are there lots of lenders who don't allow remortgaging inside of 6 months ownership? Yes. So it's kind of, I'll probably say like 30% of lenders allow it and 70% of lenders do not. So why don't people like this? Why don't lenders like lending with ownership inside of 6 months? So because I've been in the mortgage market for like ever, a really long time, I can remember this rule really coming in a big way. And this was all kind of a fallout of the credit crisis. So what used to happen is people would buy a property at below market value, let's just say for £100,000, and they would borrow 75% loan to value to acquire it. They would then remortgage within 6 months of ownership. Generally these are very sort of good transactions where people were able to secure properties at very good prices. They always tend to be distressed sales. So the person selling a property, people don't want to let their property go for a song unless they're really, really stuck. So people are about to be repossessed, family breakups, all that kind of stuff. So what they would then do is they bought the property for £100,000, they've taken £75,000 mortgage, they were then able to get a remortgage inside of 6 months, so the property's worth, say, £150,000, borrow 75% of that. At this point, not only have they got a mortgage which equates to more than they actually paid for the property, but they've also come away with some cash in their pockets at this point. So they've got no skin in the game, essentially. So lenders, this obviously caused a real problem during the credit crisis, as you imagine, and lenders kind of frown on this. And also distress sales are something that actually, it's not to say they can't be done, but actually if you're going to kind of move into that kind of part of the market, it's quite a regulated part of the market, and rightly so. So what lenders don't really like to see is people who are seeing remortgaging property inside of 6 months, because it kind of calls the question, well, why on earth would you be doing this? How have you been able to add value to the property? And all this kind of stuff. So that's why lenders don't like it, because it can be seen as being an area of the market which can be quite murky, not to say it always is. Now, in terms of if you do want to remortgage inside of 6 months, here's what the lenders kind of do look at. And there's lots of really good lenders that do this. So off the top of my head, you've got high street lenders like Virgin. Then you've also got specialist lenders like Paragon, Kent Reliance. I mean, there's loads of specialist lenders that will do this. It's the high street that tend to step away from it. So what they want to see is actually if you're remortgaging inside of 6 months and the property, you're only saying the property is worth what you paid for it. So actually, I bought it for £100,000. It's still worth £100,000. Can I have a mortgage, please? That's a really straightforward one, because we're not actually saying we've added any value to the property. If you are saying that the property is now worth £150,000, just going back to our previous example, they're going to want to understand how you've been able to obtain such a large uplift in the property value. So the example we see of this often would be that I have done a bunch of refurbishment works to the property. I've spent £20,000, now it's worth £150,000. If we can get the lenders comfortable that you can justify why you've seen a high uplift in value over a really short period of time, then broadly speaking, lenders are very happy to work with you on these kinds of deals. So there you go. So that's a bit about early remortgaging, as we affectionately call it here at MFB. But just sort of going back to the headline news, it's really good to see that Aldermore have revisited their criteria, seen there's kind of a gap in the market, really got under the bonnet of why landlords might want to do this type of transaction, understood that actually just because you want to remortgage inside of 6 months doesn't mean that there's necessarily anything sinister going on, and decided to support landlords in this way. Okay, now Metro Bank have made a change in the last week, which is not going to be relevant to the vast majority of you, but actually you never know when this might come up in a pub quiz. So did you know that lots of lenders cap the maximum rent that you can charge your tenants on a single AST at £100,000 per year? Again, you probably wouldn't know, because the vast majority of us don't have a property which will command that level of rent. But for those people who have larger properties in, so for example, prime central London, actually this is really, really relevant. So joking aside, this will actually affect lots of people. So the reason that the rules are there with some lenders is that actually where you're charging over £100,000 per year, your tenancy would be excluded from the Housing Act tenancy, so it wouldn't be an AST. So the rules would be different. Therefore, actually, it would be regarded as a common law tenancy, essentially. So the rules and protections afforded to tenants and landlords are slightly different under this arrangement. So there's a lot of lenders who just say, look, too complicated. Vast majority of people, it's never going to impact, so we'd rather just not lend on it. We're not going to invest the time and resources to understand this. But Metro Bank are a lender who do pride themselves on understanding complex incomes and being able to take on large loans. So it's actually really encouraging to see that they've kind of recognised that if you limit rents of £100,000 a year, you're actually excluding a large chunk of the prime central London market, a market where Metro Bank really want to play. So good for those guys. And if it comes up in a pub quiz you're doing over Christmas, you are welcome. Lastly, I just want to have a quick chat about service charges, because this seems to be more and more of an issue coming up. Maybe it's just because more lenders are aware of it, maybe because service charges have just been increasing really, really rapidly. And the reason, what prompted me to talk to you about this was actually I had a client who last week had applied for a mortgage. The property value was around £200,000, but their service charge was over £3,000 per year, and the mortgage application got declined by the mortgage works. And the rationale for that was that actually they felt that the service charge was simply too high compared to the property value, and therefore it would be a deterrent for people being willing to buy the property from our client in the future. So essentially it would impact resale, which got me to thinking that actually this is something that is worth talking to you about. So generally speaking, lenders want the service charge to be no more than 0.1% of the property value. So if you've got a property of £100,000, then really the ground rent should be no more than £1,000 per year. Now, in researching the options for this particular client to figure out what on earth we're going to do with his mortgage, actually we were able to find a number of lenders who take a slightly more pragmatic view. So the first thing they were saying is, well, why is it so high compared to the property value? You know, is there some kind of facility in the property, for example, concierge or swimming pool, you know, what's going on here? And actually, in this particular property, there is a concierge service, which was actually a large chunk of the service charge. So the service charge, it's not that you're paying lots of money because there's something wrong with the property, that there's going to be lots of work, so they're building up a massive sinking fund. You're paying for a service. This really helped things. The second thing was that actually, looking at the breakdown of the service charge for this particular property, the leaseholders are going to be putting in a large amount of money every single year because they're really kind of trying to build up their sinking fund. We've been able to get confirmation from the managing agents that actually next year the sinking fund is kind of largely built up, as it were, and therefore the service charge would be slowing down because they got the kind of money they needed. So on this basis, actually, there were quite a few lenders who were prepared to take a view on the higher service charge, because we have a concierge service, because actually there is a reason why it's been so high and it's going to come down in the next couple of years. The third bunch of lenders said to us, well, actually, look, we don't have a rule around how much the service charge can be, so this 0.1% rule doesn't apply here. But what we're going to do is rely on the valuer's comments. So if the valuer comes back and says, actually, the service charge is £3,000 per year, but actually I don't think that's going to impact the saleability because, you know, there's a concierge service or whatever the reason is, then happy days. If the valuer comes back and says there's a really high service charge and this would actually really impact the resale, then the lender's going to decline the application. So as you can see, there's kind of various camps that the lenders sit in, but the very good news is if you are someone who has a property with a sort of above 0.1% service charge, then we can certainly help you. The advice here is if you are looking at buying a leasehold property and the service charge is more than 0.1% of the property value, it's probably worth just having a really good think about the fact that that is going to some extent impact how many mortgages are going to be available for you going forwards, and also potential resale as well. And there you go, a very mortgage update for you, how unlike me. If you have any questions on any of the stuff we've talked about today or anything more broadly, please do give us a call. We'd always love to hear from you. 0345 345 6788. And as always, there is an abundance of information available on our website, mfbrokers.co.uk. Have a really good week. Don't get washed and blown away. And I look forward to speaking to you next week. I might even have a little Christmas tree up. You never know.